Good afternoon and welcome to the Strategy of the Day. I'm Dan Hussey, Senior Market Strategist with Zaner Ag Hedge. The July WASDE is in and it came in friendly. USDA cut new crop corn stocks on stronger demand, said soybean use absorbed the bigger crop, and pegged the smallest U.S. wheat crop since 1970. The market agreed. December corn settled up 9 cents at 461. November beans up better than 9 to just under $12. And September wheat in the Chicago contract up to 20.5 with the KC up 22. Before we go any further, let me be clear about what we're doing today. This is an educational and advisory video, and when I give you an opinion, I'll tell you it's just an opinion. There is real risk of loss in trading futures and options, and they're not suitable for everyone. Here's what we'll work on today. First, the report numbers and what the USDA actually said. Then we'll put the charts up and take a look at each one at a time. First corn, then soybeans and wheat, and a marketing plan decision that each one hands you. Then 4 questions to pull it all together and where the Zaner early wire fits in. So let's get into it. We're going to start with the numbers because for once the report actually moved the needle. 3 things. Corn, quietly the friendliest of the 3. The USDA cut new crop corn ending stocks about 170 million bushels, down to roughly 1.8 billion on stronger feed demand, actually just below 1.8 billion. And they trimmed old crop stocks too. That came in below what the trade was looking for. Yields were left at trend at 183 bushels an acre, and the way they almost always are in the July report. Soybeans, a bigger crop, but demand went right along with it. USDA raised production to about 40 million bushels on harvested acres, kept the yield at 53, but they raised demand, bumped exports on China, and the ending stocks held steady at 310 million. The bigger crop that didn't loosen the balance sheet is a supportive read, not a bearish one. And wheat. That's the headline today. USDA pegged the smallest U.S. all wheat crop since 1970-71 marketing year, with ending stocks down better than 20% on the year. Genuinely a tight situation. So a friendly report across the board, and the market closed green on all 3. Here's the decision that comes out of that, and it's the most important one today. The July WASDE is out, and here's the headline for your operation. The market looked past the balance sheet and traded higher. December corn's back up near 460. New crop beans are knocking on $12 again, and wheat's holding a multi-week breakout. That's the market handing you strength on a report day. And in my opinion, strength on a report day is exactly when a written plan earns its keep, not a prediction that keeps going, because it might not. And there's real risk of loss either way, but a plan that tells you which bushels you priced into a rally like this one. So don't guess and don't freeze. Execute the sales you already planned out, and the early wire frames that call each morning. Links are below. Opinions are mine, not a recommendation to buy or sell. The report was the event you've been waiting on to make this decision. It's behind you now. It leaned your way, and the market went higher. So the question isn't what will the USDA do anymore? It's what did I say I'd sell at these levels? And I'm doing it. Let's take it grain by grain. Let's start with corn. Here's the corn chart. December corn round tripped its 2-day pop earlier in the week and closed right back near the highs at 461, and now with that friendlier balance sheet under it and a weather premium on top. And the premium is real and it's uneven. Too much rain in the eastern corn belt, some flooding trimming yields in spots, drier conditions out west, and heat in the forecast right as the crop moves through pollination. Our friends at Allendale put it well. The next 2 weeks set most of the corn yield. That can keep a bid under this market and weather premiums building. But, and I'll always give you the other side, that premium can come out just as fast as if those rains spread and the crop makes. So new crop corn is a scenario, and it's a sales scenario. If your written plan named targets in the high 450s or the low 460s, the market has now offered you that twice in 1 week. My opinion, that's not a level to stare at and hope for more. It's a level to scale into your plan. Get some coverage on. If you genuinely believe the below trend yield story, then keep some upside open, but do it with defined risk, an option floor or a reownership tool where you know the cost and you know the risk. Either way, the pair the opportunity with the reality, and that's the future. Hedge to arrives and options all carry margin, basis, and opportunity risk. We've ran up into the 200-day moving average and that cluster of moving averages that we were so valiantly holding above. This is a very visible place on the chart, and while we do have a bullish outbreak to an outside day higher for corn on very sizable volume, this is going to be a tough spot to chew through. Let's move on to beans. New crop soybeans are back near $12 and corn's pushing higher after the report. So let's talk about planning your sales. Here's the thing. It's my opinion. A market that's moving your way is not a reason to freeze, and it's not a reason to dump everything either. It's a reason to work your written targets. A price, a date, a percentage of the crop. Scale into strength instead of trying to guess the exact top here, because a rally built on weather and demand headlines can turn just as fast as it came. That's the risk of loss and the reality. So for the bushels that haven't been priced, this is a conversation with your advisor. What's your next target and what will you actually sell when you hit it? Price into strength on terms, and the early wire link below can help you determine just that. November soybeans out over 11.90 into the close, unable to close the week above 12, certainly isn't the best perspective. But that 4.47 billion bushel crop and exports raising is a good reason why we're still holding clear and above that old left shoulder, potentially right shoulder target at 1170 that now we have created a proverbial bull flag above. Extension out above 12, and we can start pricing those higher bushels. But for right now, if you looked at yourself back in June and said, boy, I regret not having done something when we were closer to $12, this is the market giving you that opportunity. Remember what the USDA told you. Demand absorbed a bigger crop. That carryout held steady even though a crop grew, and they bumped exports to China. That tariff reduction news out of Beijing this week, and that's a genuinely improved demand picture, but it still needs to show up as sustained purchases before it's demand you can bank on. So on beans, and in my opinion, I'd rather be a planned seller into the strength with written targets, not a hoper for more. And wheat in the Chicago September contract. The wheat chart, the leader this week, September Chicago up better than 20 cents and KC up 22. This is a breakout that is rock solid backbone now. The smallest U.S. crop since 1970 and record low acreage. That's a supply story that doesn't evaporate overnight, and it's why wheat led the board. But tight supply is a reason prices can firm. It's not a promise they can keep going, and wheat still has to get through harvest with its quality and its final size. So for wheat commercials, a breakout into a crop like this is tight. Into a crop this tight is exactly when a written plan tells you whether to reward the move with some coverage now, with defined risk or wait, and with a target written down. Unpriced bushels into a rally are a decision, not default. Make it on purpose and make it with your risk defined. Chicago wheat closing above 640 here, not quite out to a right shoulder target that could develop into 460 or 660, excuse me, with proverbially a neckline around that 200-day moving average. But this week we took out all major moving averages and closed out above. My guess is that we're going to see some extension higher now that we're back above that 18-day. And let's not forget, the largest volume day for September wheat is nothing to sneeze at. So 4 questions here to bring it all home. Let's put it together. The framework I can keep coming back to. 4 questions, and after a report day like this, they're about execution, targets, coverage, floors, and basis. 4 questions to work your own marketing plan now that the July WASDE is in and the market has settled higher. Our first, targets. You wrote prices down. Did this week's rally trigger any of them? And did you act or just watch? 2, coverage. After a move like this, does your percent priced still match your plan, or are you unsold into and undersold into this strength? 3, floors. A higher market changes the math on downside protection. Are floors cheaper or dearer now? And do you know the cost and the risks associated with them? Something a Zaner marketing advisor can certainly work through with you. And four, basis. Did your local cash keep up with the futures or did basis weaken as the board ran? A rally that you can't capture in cash isn't the same as sales. No safe side, real risk of loss. If you can't answer all four, that's this week's homework for you. Build it with your advisor and check out that early wire Zaner link below to try to get up-to-date information every morning to help you make these decisions. And I want to be clear on what all of this is. It's a process and discipline built with your advisor around your specific operation. It's a plan to execute, not a one size fits all signal. And I'm not handing you one right now today. If this week's strength took out a target you'd written down and you acted on it, that's a plan working according to your decisions. If the market's giving you a look and you froze, waiting for a top nobody can predict, that's your plan asking you a question. Answer it on purpose. So let me bring this home and finalize today's video. The report is behind us. It came in friendly and the market closed higher. And that is an opportunity to execute the sales you plan. It is not a guarantee that price can keep climbing. There is genuine risk of loss in trading in futures on options, and weather and demand rallies can reverse just as fast as they were built. And nothing I've said today is a recommendation to buy or sell any specific contract. But if your operation planned it as sales, a day like today is when you execute. If it didn't, a day like today is when you wish you had. Here's where the Zaner Early Wire helps. It gives you a pre-open context every morning. The overnight tape, the reports on the calendar, the levels people are watching. So you can work your targets, your coverage, your floors, and your basis with your advisor before the bell. The link is in the description below. And if you like more of a one-on-one look with your written plan while market's giving you this good a pricing opportunity, reach me directly at dhussey@zaner.com or 312-801-4231. That's 312-801-4231. Feel free to reach out. The information is always free. One last thing, and I mean it, there is substantial risk of loss in trading futures and options, and they're not suitable for all investors. Past performance is not necessarily indicative of future results. I'm Dan Hussey. This has been a strategy of the day. Plan your sales, price into strength on your terms, and I'll see you all next time. Have a great weekend, everybody.